So, in this lesson, we'll be talking about false order blocks or smart money traps, which institutions use to manipulate the market. And when you enter, you end up getting liquidated and the stop loss being hit. Let me show you examples of this. In the market, let's make an example of an uptrend. It goes down, then makes the smaller, and then breaks up like this. Now this is in the uptrend. Make one for the downtrend. Go down, market retraces, it goes down, then retraces, it goes down there, and then it traces back a bit and then goes down like this. So this would be our break of structure right here. We have marked, this would be our EOS. Okay, then this would also be our BOS. And yes, and then this will be our BOS again. This one, BOS. Same as the bearish example. We have break of structure, BOS. We have our BOS right here. Right. Okay. Let me clone this. Clone. Here we have another BOS right here. Like this. Now, these are the most common types of inducement or smart money traps. Where right here we have our demand. Here we have our demand zone, price tips, goes up, let me make another demand, and you have this one, which I'll mark in red. Okay, the demand. There's another demand zone there. There's another one there. But this one has already been mitigated. So we don't look to trade on that one, right? This has been mitigated demand. This one has not been mitigated. This one has not been mitigated. And this demand was the one which caused the break of structure right here. Same goes for the bearish example. Here we have our supply. There we have another supply there. Remove this. Clone. There's another supply there. This one. Remove this one. It's supposed to touch the supply zone. This is another supply like this. Now, but this one is mitigated supply. Like this. Now, okay. So let me start with the bullish example. Here we have our break of structure, and this demand which caused it has been mitigated, and then we have it goes down it goes up and fails to break the recent low, the recent swing high, then it comes back and goes up again, making another demand zone here. So inducement would be this demand zone right here, because when market comes back to this area, right, many of you will look to trade this demand zone, and then when you put your trades here, market will only react a bit to this zone, then go down to break into mitigate this one, and then goes down, it goes up like that. So this would be our inducement in the smart money concept. Same goes for the bearish example. Here market comes back, reacts a bit to this zone, goes back up, goes back down, then continues to the supply, taps it and goes down like this. These two are the most common types of inducement. And now let us go to some real chart examples. So here we have step index in the 24-hour time frame, right? Mark our demand, our supply right here, like this, right? And then we said market will go down, so this is our break of structure right here. It was in an overall, this was an overall downtrend like this, right? We said market will break the structure, go up, and then it will fail to break here. Here it failed to break. Let me change the color to make this more visible. Let me try this one. Yes, this, it failed. It is our supply, break of structure. It went down, broke this structure right here. Then when it went back up, it did not mitigate the supply, or this one right here. There's a supply there, right? And then when it went back down to this point, it went back up, and then it did not mitigate the supply. The supply did not touch our order block, right? And then it went back up. It was now in a sort of a consolidation. It went back down here, it went back up again, it went back down here, it didn't break this low right here. Then it went back up again to touch this point. This point was touched again, right? Like this. Yeah, like this. Then it went back down, and then it finally broke the structure right here, right? This will be our break of structure, BOS, right? Right. So, and then this is the order block. This one, let me mark using a circle. This order block is the one which caused this break of structure, this supply area right here. Right, now let's see how the market reacted. When market broke structure, when it went back up, when it stitched this zone, you can see there's a black candle right here. This black candle, this is just the reaction to this zone right. And then it broke this level, then went up, came back down. It did not break the structure, so this structure wasn't broken yet. Like this. So now it failed to break, again here, then it finally went back up. This would be our inducement, right? Then another inducement zone would be this one. This would be another inducement zone. Why? Because this liquidity lying on this area, because they're equal highs. So many price action traders will look to take it as a double top and look for selling opportunities. When it comes back, they'll say it's a triple top so that they look for sell opportunities, but they'll be forgetting that this supply has not yet been mitigated. So this one will be our inducement. This one also be our inducement because of the equal highs lying above it. So this supply zone would be our trap or inducement. So like this. So like this, right? And then this would be our inducement like this. Now, thank you guys for watching, and I'll catch you in the next video.